1986. Larry Fink is one of the most respected bond traders on Wall Street. He isn't gambling. He is methodical, and by every available metric, he is winning. Until he isn't. One miscalculated bet on interest rates quietly compounds into a catastrophe. By the time the dust settles, his division has lost around $100 million. A decade of reputation, gone in a season. He doesn't ask why he lost. He asks something harder. With all his experience, why did he have no accurate picture of the risk he was actually carrying? 2 years later, in 1988, he starts a new firm. Not to predict the market, to measure it. That firm now oversees more than $15 trillion, and what it actually built gets mistaken for ownership. It isn't. It's stranger than that. People hear BlackRock owns Apple, owns Exxon, owns Microsoft, and picture a company sitting on its own mountain of cash, buying up the world. That's not it. The money moving through BlackRock isn't BlackRock's. It's yours, or it could be. Pension funds, teacher retirement accounts, your 401k, all of it gets pooled and handed to firms like BlackRock, mostly through index funds. Funds that don't try to pick winners, they just buy a slice of everything, automatically, the way a grocery store stocks every brand instead of betting on one. The moment millions of people put retirement money into one of these funds, BlackRock shows up as a listed shareholder almost everywhere. Not by choosing companies, by the math of the fund itself. So BlackRock isn't buying the world, it's becoming the address where millions of small ownership stakes get filed. But here's where some economists push back on how harmless that sounds. A group of researchers looked at the airline industry, where BlackRock, Vanguard, and a handful of other firms hold large stakes in nearly every major carrier at once, and found ticket prices were higher than you'd expect in a competitive market. Their theory? When the same investors own all the competitors, nobody benefits from fighting hard for market share. Other economists have disputed the size of that effect, and the debate is still unsettled. But it's a real argument, made by real people, that passive ownership isn't as neutral as it looks. Either way, filed ownership still comes with one thing that isn't in dispute: votes. (2021). A tiny hedge fund called Engine Number 1 declares war on ExxonMobil. Their case? Exxon's board was ignoring the shift away from fossil fuels, and it was going to cost shareholders money. Engine Number 1 owned about 0.02% of Exxon. On their own, they had nothing. So they made their case to the big index fund managers instead. BlackRock voted with them, casting the combined weight of millions of retirement accounts behind a firm that barely showed up on the cap table. 3 new directors were forced onto Exxon's board over management's objections. A fund that owned almost nothing had just reshaped a Fortune 10 boardroom. That's the story everyone tells. Here's the part most retellings leave out. 2 years later, BlackRock was retreating. Republican state treasurers started pulling billions in public pension money out of BlackRock funds, accusing the firm of playing politics with climate votes. By 2023, Larry Fink said he'd stop using the term ESG altogether because, in his words, the term had become weaponized. BlackRock's own climate-related shareholder votes dropped sharply the following proxy season. So the same firm that toppled an oil giant's board also folded under political pressure 2 years later. That's not a company quietly running the world. That's a company whose power has a ceiling, and the ceiling showed up faster than anyone expected. Voting power is the visible layer. It shows up in headlines. What doesn't show up in headlines is something bigger. You can't run $15 trillion off spreadsheets. So back when BlackRock was founded, Fink's team built a piece of software to track risk in real time. They called it Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. Here's what it actually does. Aladdin ingests the position-level data of a portfolio, every stock, bond, derivative, and currency exposure inside it, and constantly runs that data through stress tests. What happens to this portfolio if interest rates jump 2 points overnight? If oil prices spike? If a major currency collapses? Aladdin doesn't wait for those events to happen. It models thousands of versions of them continuously, so a fund manager can see the damage before it's real. That kind of depth is hard to copy because it isn't just code, it's accumulated history. Aladdin has been running continuously since the late 1980s, through the dot-com crash, 2008, and the 2020 pandemic freeze. A competitor starting today isn't just writing software. They're trying to compress 35 years of market cycles they never actually lived through into a system that's never been tested by any of them. Which is also why institutions keep choosing it, even knowing what that concentration means. For most of them, the cost of building an equivalent system from scratch is higher than the cost of depending on one that already exists and already works. That's not a conspiracy. That's a straightforward calculation made independently by hundreds of institutions that arrived at the same answer. That's why banks use it, insurance companies use it, sovereign wealth funds use it. Vanguard, BlackRock's direct competitor, has used Aladdin for its own risk analytics. In March 2020, when markets froze at the start of the pandemic, the Federal Reserve hired BlackRock to help run its emergency bond buying programs. And here's the detail that changes how you should picture it. Aladdin isn't only a risk calculator sitting off to the side. For many institutions, it also includes the order and portfolio management tools they use to actually place trades. The decision to trade still belongs to the institution. Aladdin doesn't make that call on its own. But for a lot of BlackRock's clients, the same platform that flags the danger is also where the trade gets executed in response to it. Aladdin isn't just watching the market from a distance. It's built into the market's own machinery. What's proprietary, the exact models, the exact weightings, the internal logic, that part genuinely isn't public. But it isn't a total black box either. Regulators can examine it through supervisory review. Clients see how their own data moves through it. What the public doesn't have is that same access, which is exactly why outside estimates of Aladdin's reach vary, and why regulators are the ones raising the concern, not guessing at it from the outside. Here's the shape of the concern, stated plainly. 2008 had many causes: bad mortgage underwriting, opaque securitization, excessive leverage, thin liquidity. One well-documented thread running through several of those causes: a small number of credit rating agencies used strikingly similar models to assign ratings to mortgage-backed securities, ratings that the rest of the market then relied on to price that debt. When those models turned out to be wrong, they were wrong almost everywhere, almost at once. Shared models don't guarantee shared failure, but they remove one of the things that normally contains it: the natural variation between institutions that stops one bad call from becoming everyone's bad call. There's a name for this pattern outside of finance. In agriculture, a monoculture is a field planted with one genetically identical crop. It's efficient until a single disease shows up. Then there's nothing in the field to stop the spread, because every plant shares the same weakness. Apply that carefully. The claim isn't that finance is exactly like farming. The claim is narrower. When many independent institutions rely on the same underlying risk model, a flaw in that model has a pathway to surface in many places at once, not just one. This hasn't happened, at least not in any way traced back to Aladdin specifically. But 2008 shows the mechanism is real, which is exactly why the Financial Stability Board has flagged concentrated risk infrastructure as something worth watching. This isn't a story with a villain. It's a genuinely useful tool, adopted by genuinely rational institutions for genuinely sound reasons, that has become something nobody, including BlackRock, fully controls once it's this deeply embedded. So, BlackRock doesn't own almost everything, and there's no one pulling strings from behind a curtain. What it built was simpler and stranger. The infrastructure that moves retirement money into the market, the voting power attached to that money, and the risk engine that a large share of the financial system now uses to understand its own exposure, and, for many of its own clients, to act on it. None of it required a conspiracy. Every piece was adopted because it was the efficient choice, one rational decision at a time for almost 40 years. The efficient thing to do and the concentrated thing to do kept turning out to be the same thing. Institutions still made real choices about vendors, about strategy, about governance. But at nearly every one of those decision points, the incentives pointed the same direction, toward the platform with the deepest history, the widest adoption, the most tested track record. Concentration was never the goal. It was the byproduct that kept showing up anyway, decision after decision. Go back to where this started. In 1986, a young trader lost $100 million because he couldn't see the risk sitting on his own book. That failure is the reason Aladdin exists. It was built to answer one question: what if you could actually see risk clearly before it was too late? Decades later, a huge share of the global financial system now sees risk through that same machine. Think's original question didn't go away. It just changed size. If the model is wrong about something today, some assumption nobody's tested, some scenario nobody's modeled, the honest answer is that we don't know how far that error would travel, or how fast. Nobody does. Not yet.